Okay, colleagues, welcome to this session on the debt and financing conundrum. How can debt sustainability assessment reform help? My name is Oliver Schwank. I'm part of the DSA team and master of ceremony in this room. And I have a very simple task, which is to hand the floor over to our distinguished moderator, Professor Galpern, who will guide us through this session. Professor Galpern, the floor is yours.
Oliver, thank you so much for hosting us and mastering these ceremonies. Our topic, as you can see from the program, is the role of debt sustainability analysis in the debt and financing conundrum. And I think this title is extremely important because it is very easy to focus on either financing or debt and forget that they're really part of the same picture and very much the same conundrum. As background for this session, I recommend and I believe that you can find links to the FES Jubilee USA paper series on DSAs and their role in international financial architecture. I do want to flag one point which I think comes through in many of the papers, but bears emphasis. And I think particularly bears emphasis on a day when academics are speaking, and that is that theories of debt sustainability are overwhelmingly grounded in theories of debt overhang, which are all about the efficiency of debt financing and a debt burden, and in particular about when it makes sense for creditors to forego some of the debt payments. And this focus on what makes sense, what is efficient, and what is sensible from the creditor perspective, I think permeates so much of the methodology in this field that it, I think, bears emphasis and again calls for special attention when we are talking about alternative perspectives on sustainability, right? So it is very different to ask how much debt is inefficient and how much debt is too much so that it's not repayable, as opposed to how much debt is oppressive, how much debt is immoral. When does debt financing make sense for human flourishing and similar? Debt sustainability is certainly an analytical and theoretical concept, but it is also an institutional practice that shapes institutions and evolves over time. It's a dynamic construct that I think is undergoing a particularly interesting moment of change, partly owing to the climate crisis. Debt sustainability analysis has been the subject of debates over transparency, again, something that we will discuss on this panel, and who gets to see and have input into the analysis itself. And finally, the question of agency and authorship looms large. Who authors the sustainability analysis? From whose perspective, coming back to my initial point, is the analysis structured? And what do we do with it, right? So once the analysis is out there, what happens if debt is unsustainable? Where do the losses fall? So all of these questions, I think, are before us, and we are extremely lucky to have a very distinguished panel to discuss them. Matthew Martin, who's a Director of Development Finance International, Sherilyn Braga at ODI, who is couldn't be with us in person, but is participating by video, Gail Hurley, who is with is it Resi or RESI?
Resi's fine.
I didn't want to sound like the dinner reservations after. From Resi, and then by video, Mahmoud Moeldin, who is, of course, the UN Special Envoy on financing the 2030 Sustainable Development Agenda. We will start with some opening remarks, beginning with Matthew. Thank you so much.
Thank you. I have a PowerPoint. Yes, while that's being put up, just let me say, first of all, two things. One is that I come at this very much from a practical point of view. Been doing debt sustainability analysis with developing countries for about 35 years, before the IMF and the World Bank started doing it. So trying to bring some of the lessons of that to the discussion.
Your presentation. What's your name again?
Matthew Martin. And then secondly, to say, I was looking before this at what member states have been saying already as part of the inputs to the Elements paper, and realizing that this is quite the whole issue of debt sustainability frameworks and analysis is quite a live issue. But in contrast to what Naveed suggested to us at the beginning today, it's being dealt with, it seems to me, in quite a fragmented way, apart from the Africa group, which seems to have said that we need to bring in all long-term development needs and sustainability goals. Quite a lot of, if I can put it this way, northern countries are focusing more on how do we adapt to climate, and in some cases to nature issues, and then Germany is also looking at social protection. So it seems to be being done in a slightly fragmented way without drawing everything together into a new paradigm. So what I want to try to do is to discuss how we could actually do that as we go forward. So the paper that I wrote for the Jubilee USA and FES series was about how we could integrate the SDGs into DSAs, and it looks at why it's essential to integrate the SDGs and their financing into debt sustainability analysis, analyzes both types of debt sustainability analysis. For those of you who are not specialists, there are two types. There's one for low-income countries, and there's one for market-accessing countries, now known as the SRDSF. Ideally, of course, one would integrate, and this was a recommendation that we used to make, and which is in a report I did for Norwegian Church Aid now 2 years ago. We would have recommended the integration of all of the SDG spending needs into DSAs. But let's be realistic. Post-COVID, we probably all need to admit that there's no way we can either spend enough or find enough funding to reach all of the SDGs by 2030. It's really important that this doesn't become, when we presented collectively these conclusions to the IMF and the World Bank boards about 2 months ago in Washington, one of the questions we got was, if you add in all these extra spending needs, doesn't this just mean that every country's debt will be unsustainable, they'll all be bankrupt, and they'll all need debt relief? So that's why the title of this panel is Resolving the Debt and Financing Conundrum, because you have to put in the positive effects that that spending is going to have and assumptions about more concessional financing sources in order to show that you can actually fund the SDGs without having unsustainable debt ever. And I look at why it's essential, what's being done now, and how we can do more, with a particular emphasis on practicality. Everybody involved in the process, from the IMF, the World Bank, governments, and so on, have all said we need to do this in a simple way with minimum extra workload for all parties. How to choose priorities for which SDGs to integrate? Well, from my point of view, which might be a slightly biased one, we have three really major extreme crises on the planet at the moment. One is climate, the second is biodiversity and nature, and the third is extreme inequality and poverty. All of them having huge, broader economic and political impacts. The second reason for choosing these is that they're also areas which, to some degree at least, both the IMF and the World Bank are already focusing on in their programming and surveillance. But above all, I think we should be talking here about responding to the demands of the world's citizens. And if you're going to countries like Tuvalu and Chad, or to countries like Colombia and South Africa when it comes to inequality, and you're not talking about what their citizens regard as the biggest crises that the countries are facing, then you really don't have credible programs at all if you're the IMF and the World Bank, if you're ignoring the top priority crises. And currently, so we're clear, all that's really integrated into the baseline scenarios for debt sustainability analysis is a sort of business as usual, grossly inadequate level of current spending on these three crises. At the same time, we have G77 countries currently facing the worst ever debt service crisis that they've faced, and a massive crowding out of SDG spending in all of these areas. It's in the Norwegian report that I talked about, but it's also in our Debt Service Watch database, which is online. And research from Boston, indeed done by Marina and her colleagues there, shows that if you just carry on funding this current spending, but particularly if you carry on funding the climate-related spending and scale it up at current financing terms, then virtually every country will have a solvency crisis as well as a debt service crisis in a few years from now. So we've got to bring in, as I said, the positive economic benefits, and those need to be integrated through what you might call a just green transition that deals with all of these issues at the same time. And then you can show that increased debt carrying capacity will come through higher growth and higher budget revenue. And you can also bring in what would be the less debt-creating financing that you could get from grants, concessional loans, and tax revenues. What's the current situation? Well, the IMF has started to integrate climate into the market accessing countries, DSA. I'm not going to go into all the details of this for time reasons, but there are submodules that you can use to add on an extra scenario or extend your current scenario in a different direction. There's a costings methodology drawing on the NDC and NAP reports for the FCCC. There's a clear definition of the most climate-affected countries which should be covered. There are customized scenarios in which you could allow for positive multiplier effects and more concessional financing. But these are, from my point of view, not going far enough by a long way. First of all, the spending you can't bring the spending in until year 5 of your forecast. Well, for those countries which are currently sinking under the waves, waiting till year 5 of the forecast is not an option. The costs that are put in are well below the levels that are currently in revised NDCs and NAPs. They're only doing the analysis for a subset of countries. And above all, the customized bits, which is where you're supposed to put in the positive multiplier effects of the spending and the potential for more concessional finance, have been completely unused since they were introduced as an option for staff to use. And then you have disasters, which countries are being hit more and more frequently and more severely by. And at the moment, they're only in there as alternative stress tests on debt sustainability. Frankly, they should go in the baseline scenario. Given that we have growing frequency and severity and inevitability, one would say, of climate events, these are no longer shocks. And they only have in there the event disasters, such as hurricanes, cyclones, typhoons, etc. Equally severe events which don't hit as a one-off, like floods and droughts, or longer-term trends like declining water table, sea level rise, deforestation, and nature disasters are not included. Let us probably not even spend much time on what's happening in the LIC DSF. Until recently, there was no consideration of any of these issues in the low-income countries framework. That's now being modified, so new guidelines have been sent out, but essentially there's a risk that they just carry on matching the faults that are in the current SRDSF. And I won't spend a lot of time on inequality and poverty either, because there's no progress at all on bringing that extra spending in. All of the things that exist on the climate and nature side, like costings, like a level at which you could decide that was worth analysing these issues, you could use already exist, and you could use exactly the same methodology as is being used for climate in the SRDSF, having improved it. And again, it's really important to have customised scenarios to include positive multiplier effects. There's really strong evidence out there that the multiplier effects of education, health, social protection, smallholder agriculture are not only very high, but also short-term as well as long-term. And those changing inequality, reducing inequality, eliminating poverty, will have a really strong effect on accelerating growth as well. So there's a huge number of things that need to be done. Just to summarize finally and to conclude, we need to really strengthen the climate modules that are in the SRDSF to make them much more realistic and urgent, and bring in key elements of the nature and biodiversity spending. replicate that for the linked DSF. There's a possibility of having the same methodology for accelerating anti-inequality and poverty spending in the DSFs, which we should be doing too. Countries should be encouraged to choose as many of the modules as, if you think of maybe even 3 separate modules of climate, nature, and inequality, as they want, and combining them where they're needed. And then it shouldn't just be a technical exercise. One of the things I've noticed repeatedly when these are presented to the boards of the IMF and the World Bank, other modules like the effect of a pensions reform are given more emphasis than the emphasis on the effects of climate, for example, in the case of Trinidad and Tobago. So really making sure that those are front and center of what the boards are discussing, and particularly showing how much extra growth and revenue spending can achieve, and reducing, therefore, the financing needs, and how concessional funds can keep debt sustainable. One final sentence, we did present these to the Fund and Bank boards a couple of months ago, and we've been working very closely with Fund and Bank staff. I think there's an openness to doing a lot more, but I think the more that FFD can press for that to be ambitious in the way that it's done, and for, if necessary, pilots to begin of doing that type of work as soon as possible, so as we can prove the concept while the reviews of the debt sustainability frameworks are happening, the better. Thank you.
Matthew, thank you so very much. I think we're ready for the video from Sherilyn, who was in rural Philippines, so of course could not reliably participate.
Should we go? Yeah, I'm looking at the colleague. Should we go to Gail first while we try to fix the technology?
So while we're loading the slides.
But I can already start.
Oh, good. Excellent.
Super. Thank you, Anna, and thank you to the UN DESA team for the opportunity to present our research here today, which I think is very relevant for the FFD4 negotiation. So my research analyses the extent to which debt sustainability analyses carried out by the IMF are sufficiently transparent, and what measures have been taken over the last few years to make them more transparent, and where the gaps still remain. And similarly to Matthew, I look at both the DSF for low-income countries as well as the market access debt sustainability frameworks. So, can I move these slides forward? Thank you. So, in the paper, I identify 3 key pillars of transparency, as you can see on the slide here, and basically look at how well DSAs measure up against those 3 pillars. So those 3 pillars are firstly public disclosure and accessibility, so the extent to which DSAs are publicly available and are presented in formats that are easy to understand. Secondly, methodological So the extent to which there's transparency in the methodologies, data, and assumptions being used to derive DSAs. And third, dialogue and engagement. So the extent to which there are clear and transparent processes for various stakeholders to engage meaningfully in DSAs, inform those assessments and inform change where necessary. And I argue that all three of those key pillars of transparency are necessary to ensure accountability and a situation in which all the key stakeholders for DSAs are empowered with the information, tools, and processes they need to drive change in both policy and practice. But of course, we don't just want transparency for its own sake, right? It's there for a purpose. So what do we expect transparency to achieve? So first and foremost, it's about accountability. So it's about better scrutiny and oversight in debt management, reducing the potential for biased decision-making. Secondly, it's about informed decision-making, so enabling diverse stakeholders to understand the public debt burden and its associated risks, but also conversely, as Matthew was saying in his presentation, if we have more transparency and information, we can also see the positive impacts of investment on growth and resilience. And then third is about strengthened international coordination and coherent policy responses to debt, which is especially critical at the moment, of course, when we see heightened debt vulnerabilities around the world. And then finally, it's about improved learning and improvements to DSA methodologies. So it builds the capacities of external stakeholders to engage, which also enables them to be more knowledgeable and effective advocates. Okay, so how did they stack up? Next slide, please. On the three pillars of transparency. Are you able to move? Another one? Yeah, no, that's it, thank you. So first on public disclosure. So arguably this is the area where there's been most progress over the last few years, and much more information, it's fair to say, is now available in the public domain than there was before. And I think there is more awareness within the World Bank and the IMF about the importance of transparency and public disclosure, and that's very positive. But there are critical differences in the public disclosure regimes between low-income countries and between the market access countries. And I argued that the arguments usually given for maintaining or putting less information in the public domain with regard to market access countries, so this is about the market sensitivity argument, I ask the extent to which that actually is a valid justification. I argue that, market access countries' debt risks are pretty much well known by the markets. They're scrutinized and analyzed very well and followed closely by markets. And we also know that many low-income countries nowadays have much more complex creditor profiles. So is there a justification for differences in the public disclosure regimes between both frameworks? I argue that doesn't stack up. So other observations I make include issues around the timeliness of publication, the language and format in which DSAs are published, very much caters more to stakeholders such as markets and lenders rather than to domestic stakeholders like parliamentarians and civil society, and there's an opportunity for change, I say. There's also much less information available in the public domain when it comes to time of debt distress or default, and that's precisely when stakeholders such as civil society, parliamentarians need far more information because the outcomes of those negotiations are extremely consequential, and yet at the same time, that's when they have least access to information. So secondly, on transparency in data, methodology, and assumptions. So here I found that improvements could be made with regard to signalling concerns around the data quality on which DSAs are formulated. So we don't know where data gaps are. The IMF and World Bank don't signal the confidence levels that their own staff have in the data on which DSAs are being derived. There's also a lack of transparency around how debt sustainability targets and thresholds are being met. So I talk in the paper about how Suriname's debt sustainability target is to reduce it to 60% of GDP by 2035, whereas Sri Lanka is 95% of GDP by 2032. Yet how those different thresholds are derived, the assumptions that sit behind them is not public and not known. And where judgment is being used to supplement the model is also not adequately explained. So there are some key gaps there with regard to transparency around the methodology, so on. And then finally on processes for dialogue and engagement, which is a really critically important area that's often overlooked. And the point, I think the key point I make in the paper is that trust and confidence in DSAs is built through active engagement with external stakeholders, like civil society, like researchers and the media and other stakeholders. And there needs to be active processes in which those stakeholders can inform and providing meaningful input into reforms of DSAs. And there have been improvements, but also the major gap that I found is that there's really limited feedback loops in place. So stakeholders don't really understand. They make suggestions, but whether those suggestions are taken on board, why some suggestions are taken forward and why others are not, such as some of the work that Matthew and others have been doing around integrating climate change, inequality, the SDGs more actively in DSAs. That's something that's only really been picked up recently, but why is never really explained. So on recommendations, I know I'm short of time, but I saw in the Elements paper that the importance of transparency in DSAs is mentioned in the Elements paper, and that's very positive. But I also think the FFD outcome document can go further on that, and it should do if we're to make DSAs a tool that's fit for purpose. So some of the suggestions I make on DSAs going forward is around moving to a system where there's firstly a presumption of disclosure for all DSAs across both middle income and low income countries. So the public disclosure regime differences that we currently see now would no longer stand. Second is around more transparency in the methodology, which I've just discussed. Another key issue is around making DSAs more accessible to a wider range of stakeholders. Even just simple things like local languages can make such a difference, but looking at what information can be more simplified. And then fourth is around establishing processes for all stakeholders to be heard in a more meaningful way and providing meaningful feedback loops, more information in times of debt restructuring subject to certain safeguards being in place is also really important. And then finally, it's unlikely that some of the concerns that have been raised by civil society and others around political pressure or bias on debt sustainability assessments and the analyses that they're providing, that is only likely to be fully addressed once there's confidence that DSAs are truly impartial and independent assessments. And so opportunities for external stakeholders to input into revision processes, input into co-creating DSAs alongside the Bretton Woods institutions could go a long way to helping to address some of those concerns. Thank you.
Thank you, Gail. Do we have... Okay.
Good day, everyone. I'm Sherilyn Raga. I'm a research fellow at ODI, and today I want to present to you the findings that we had on the paper that we've done with Jubilee and FES on assessment of debt sustainability analysis frameworks in the context of multiple crises. So first, let me give you an set of observations that we've seen by analyzing cross-country data and specific case studies. So first, there is a changing debt profile landscape in low-income countries, and these are changing in two ways since 2000s. First, there is an increasing domestic debt share in the total debt of these countries. And second, there are increasing external debt from commercial sources. So this trend already challenges the assumption in LIC debt sustainability frameworks where these countries' funding are all externally sourced and from under concessional terms. The second trend that we've observed is that there are optimistic growth and debt forecasts over the last decade. But it's worth noteworthy to highlight that there are higher forecast errors for low-income countries relative to other higher-income ones, and the forecast errors are wider during periods of overlapping shocks, particularly during the pandemic and the onset of the Russia-Ukraine war. When we dig deeper, what we've seen is that these forecast errors are driven by the optimistic assumptions on debt dynamic drivers. And this is pointing towards slightly underestimation of fiscal multipliers. Specifically, when we look at 5 country case studies, what we've seen is that there are optimistic forecasts on debt-reducing effects of revenues and growth from these countries that are already consolidating their fiscal accounts, meaning in simpler terms, these assumptions underestimated the contractionary effect of fiscal consolidation. On the other hand, an interesting case is the Ethiopia one, where they spent a lot, amounting to 9% of GDP's worth of public investment. And in these countries, the debt-reducing effects of growth is mostly underestimated in years that we've observed. So this points to other side of the fiscal multiplier literature where the expansionary effect of productive public investment is often underestimated. So because of this observations, we were encouraged to look at the elements of the DSA frameworks to see what are the limiting factors in their current setup. So first is that we've assessed that these frameworks are underestimating the fiscal multipliers. We've looked at 32 cases for 9 countries over 5 years, 2018 to 2023, and we've seen that less than 10% of them explicitly report how they incorporated the fiscal multiplier in their baseline scenarios. The second one is that there are also inadequate scenarios for large shocks and scarring. What we've looked at is that we've looked at DSA reports of selected countries 5 years back when they have combined shock scenarios, and we compared the outcome of the public debt ratio when the crisis materialized in 2021 to 2023. And what we find is that there are discrepancy for about 16 to 36 percentage points of GDP in terms of public debt ratio in higher distressed countries. So this is the difference between a shock scenario and the outcomes that can happen in actual realized shocks. So this is a huge discrepancy already highlighting that the shock scenarios in current setup are not sufficient for the magnitude of shocks that we are experiencing today. So the third one is that we look whether there are use of judgment, since we've seen that some mechanical rules are not applicable in terms of global shocks. But what we've seen by using the case study of Ghana from 2019 to 2023 is that judgment rarely step up. One, it did not account for the scarring effects of the pandemic. Second, it also neglect the fiscal multipliers contractionary effect from its proposed large primary balance adjustment of up to 5% of GDP. And also there are mixed messages on the role of market access on debt sustainability. So based on these observations and limitations, we came up with specific elements that we think would improve the DSA frameworks from what we are having now. So first is to update the DSF, or the debt sustainability framework, for low-income countries to include the debt risk assessment related to the changing debt profile in these countries, and we don't have to reinvent the wheel. Some of these assessment tools are present in the market access countries' frameworks, and these are relevant to other low-income countries with growing market access. Second is to explicitly incorporate corporate fiscal multiplier in baseline scenarios. So we've done also some stakeholder engagement, and what we really find is that there needs to be a connection between those that are doing the macroeconomic forecast, and those forecasts need to be consistent with the DSA inputs baseline scenario. So we have to be conscious on how the baseline scenarios are drafted and inputted in DSA frameworks, and to make sure that the fiscal multipliers are already incorporated, start at the onset of the baseline scenarios. Then we also suggest to activate and consistently apply an extreme shock scenario at the onset of the global shock. And we can use the global financial crisis and COVID-19 as benchmark to act as an early warning tool to assess what is the largest shock that could be tolerated before the debt becomes unsustainable. And of course, we wanted some concrete guidance on how to automatically use more judgment in DSA during large global shocks. But before I close, these are the specific elements, but there are wider policy implications. So we made these suggestions to make the DSA an effective early warning tool. We know that if forecasts are optimistic, as what we've seen, then this can lead to erroneous policy advice, and it can lead to debt distress or late debt reprofiling. And the effects would be disastrous. So by improving the accuracy of the DSAs, then we can use the DSA as a more effective early warning tool. But beyond this DSA as a trigger warning tool, we wanted the DSA to also utilize its potentially powerful potential to be used as a fiscal strategy tool. We've seen that the debt itself is not bad, but we should focus on where the debt is going into. We know from the fiscal multipliers, large literature, that there are public spending that can generate growth, higher growth, if targeted to specific sectors. For example, social protection, health, education, green infrastructure, and gender-sensitive sectors. If this debt is used in these high multiplier sectors, then it can generate growth, and this growth is actually compatible for a sustainable debt pathway. So because of this, the limitations that we've seen in the current state of DSAs, we wanted to pose some questions on how the IFIs, or international financial institutions, are anchoring their lending decisions on the DSA rating, especially if some of these elements are not relevant anymore for the multiple crises that are more becoming frequent in these recent years. So I hope these suggestions are helpful to the financing for development discussions, and looking forward to the outcome of the meeting. Thank you.
Hopefully somebody will pass our big thanks to Sherilyn for sending this video and her research. And now if we could go to Mahmoud, please, who is participating synchronously but virtually.
To address you in this important discussion. Thank you so much, Anna, for your opening remarks, and for my good three colleagues in the panel for their updates and their excellent work, Matthew, Gail, and Charlene. I'll try to do three things while reacting within the time limits to the excellent presentations. First, as the panelists mentioned in different ways, their updated information on the elements paper. And I have another reference, which is the Pact for the Future. Try to do some sort of understanding to what extent the elements paper is aligned with the Pact for the Future recommendations. And yes, it's very much work under progress, but we see in the areas related to debt and debt sustainability, good alignment, at least on the main areas of emphasis, from the reform of the international debt architecture to debt relief and restructuring initiatives, to the sustainable debt management at country level, debt transparency and reporting and indicators, innovative finance mechanisms, private sector involvement, which I'm going to refer to a bit, and then matters related to capacity building, aligning debt with SDGs that Matthew started us with, including areas related to climate, nature, biodiversity, and then crisis prevention. What is the problem really that we're trying to solve? Anna, at the very beginning, was very much, I think, hitting matters as she should when she mentioned that debt management issues need to be linked to the finance of sustainable development. And unfortunately, we don't see that all the time in the treatment. And even if we have the finance for development framework, the different chapters deal sometimes with them as if they are separate. But I think the best way to deal there in a kind of very accessible way, assume that we have a good, dependable, sustainable development framework. I'm happy to see now that people, for good reason, say, well, let's align climate SDG 13 with investments in nature and biodiversity, and that would be great then. So no silent approaches here. But all of them, without exception, would require high growth for developing economies and emerging markets. And growth needs investments in the human capital, in infrastructure, and in the resilience. That all would require savings for the private sector to invest, and domestic resource mobilization through the budget for the public investments to follow a better path without relying on debt. Having any gap on domestic savings and on the budget would require, if we are serious about growth and development, is to resort to borrowing. And here is the problem, because here the very important question about how practical the approach is to include in the SDG and climate-related investments in DSAs while maintaining simplicity and effectiveness. Even before getting into simplicity and effectiveness, we cannot solve the problem towards the very end. If the budget of the state is not really reflecting the alignment between the SDGs, priorities, and the plans that being put in the VNRs and how we are financing the budget, we are wasting a great deal of resource, and we are wasting our time, and we're going to be seeing repetitive debt cycles of distress, even if we don't really have the problem of multiple crises or polycrises that Charlene mentioned. So I think one practical area of better connectivity, the entry point related to domestic resource mobilization, including the issues related to the centrality of budget and aligning the budget, and to have these budgets from the very beginning, that would minimize really the issue of, hey, we have surprise, we have debt, let's do the debt sustainability analysis for it, because this is going to be very much repetitive in the exercise. I think that could be a kind of a common sense, but please let me know how many countries of the membership of the UN have their budgets aligned with the SDGs. I'm not even saying that, that we have an SDG kind of budgeting. Then that gets me into the matters of concern that our three speakers eloquently, based on their excellent work, and and I encourage you to have a look at their work. But I'll very much focus on the current exercise of the IMF and the World Bank, revising the two frameworks, the one on the LIG DSF, this is the low-income countries without market access, and the other exercise. But just let's be all warned here, because this is a very serious exercise that doesn't happen every year. It takes time. Since the DSA was launched in 2005, almost 20 years ago, these kind of reviews take time. And here, I'm not quite sure, really, that we have this kind of luxury of time until we have that model to be enhanced. And given that it's already started, what we can really plead to have from our good colleagues and friends at the bank, the World Bank and the IMF, is to accelerate the consultation process and to work in parallel between what they do now and the LIG DSF and for the countries with market access. for one obvious reason, because in a good day, low-income countries need to graduate and they will become countries not really qualified to be under this framework. And the other thing, that countries with market access, including low-middle-income countries, many of them already are in debt trouble. And here that gets me into a nice piece. I refer you all to it, why our World Bank friends talk about the silent debt crisis. It's very much a crisis, but we are very much silent about it. It's not like the previous crises that we have seen in the past in emerging markets, developing economies, from Latin America to the Asian countries to the African countries. Why? Because the creditors are different. It's not the Paris Club anymore. It's 40% of the debt is used to be Paris Club. Now it's less than 10%. Now there are new creditors in town, including the private sector. And it's very much more complicated to deal with this matter than, and there is a private sector exposure even for the countries without market access in the low-income countries. And then there is the growing role of emerging markets as creditors as well. And many of them do not really adhere to the Paris Club rules when it comes to debt distress or debt resolution. So, and the other thing is not just the creditors' problem or the creditors' dilemma, we have the debtors' dilemma, because they don't need really to go and engage in a serious debt management or debt restructuring exercise, because that could send some signals to the markets or to their creditors, and they may not be able to have access again to credit. And here we have a very unique case of moral hazard by countries pushing themselves not to default in debt, while they are very much could be defaulting, by defaulting on everything else. So I'm not defaulting in debt, but defaulting in SDGs. When your country is spending more than 50% on interest, I'm not saying debt service, on interest, what is left then, I'm encouraging you to have the updated information from the World Bank, IMF, from the UNCTAD in its work on the world of debt, that to see countries with spending on debt service more than what they spend on health and education put together. Then very quickly, not to upset our moderator, very quickly then what we're expecting then to happen. Yes, we have frameworks since 2005. We have frameworks since 2005. If the current framework fit for the purpose for now, yes, there is some debates, yes, that the current framework had served the global system well by sending the early warning indicators and the alarms, and with little deviations from what is expected in terms of alarms. But did these alarms really shared to come to the point of transparency and disclosures? Or we did just have the analysis without really sharing the information with the concerned bodies or public? This is a very important issue, because sometimes you may have the early warning, but you don't really share it, in fear that you may cause some sort of acceleration of a debt problem. Then there is a weakness in the current systems, and actually weaknesses, I would say. Domestic debt vulnerability, and I encourage actually the panelists to dwell more in their excellent work, not just on the external debt, but on the domestic debt vulnerability. And the other thing, because many countries now are resorting to their domestic market, and if you are with a system of pegged exchange rate, there is a great deal, and actually if the floating currency is not floating enough, there is the worry about what's so-called carry trade and issues related to hot money at the same time. The current frameworks don't capture these points adequately. And then I think earlier colleagues mentioned the inclusion of clauses related to climate, to nature. Yes, there is some sort of incorporation of climate change risks and policies, but not adequate enough. What is really missing as well, that IFIs and international organizations tend to group countries, but we need really to know, and we understand this, that countries within these groups have their own heterogeneity that needed to be dealt with in a better way. So some sort of better granularity that could be allowed with these frameworks are basically for standardization. But yes, when it comes to treatment, we need really to have a kind of a case-by-case kind of treatment. And then there is that kind of mix between the science and the art that we need really to have these kind of new frameworks under construction now to be guiding us with science and evidence, but they need really to have the possibility of getting us with better judgment of what should be done. So yes, I can see the moderator approaching him toward me. If I just have a few seconds, what we need then is all of this kind of coverage, dealing with matters with better flexibility, dealing with issues related to the predictive accuracy of these frameworks, and dealing as well with issues related to the new players here, basically role of domestic markets, private sector, and the new creditors. One final thing that had been with calls from people like Mike Spence and others, and Joe Stiglitz and others, it's basically about how to treat public investment. We cannot really treat public investment as we treat public consumption when it comes to debt. They are not treated the same. If you are in debt, you are in debt, you are in debt. And I think the origins of the debt, and here goes back to this issue of the SDGs and investments in the SDGs, needs a completely different breed of a framework than the one that we are tackling here. Having said that, very grateful to the opportunity and grateful to the moderator and our great three panelists. Thank you so much. Over to you.
Thank you so much. We have so much material for our discussion, and I would love to just pull out a few threads and open it up perhaps for discussion so that we also have time for the panelists to respond and elaborate on some of the points that they have made. So one thing struck me in several of the presentations, and Gail in particular spoke of the debt sustainability analyses being fit for purpose, and Sherilyn spoke of the accuracy of DSAs, and of course, the question that I keep struggling with is what exactly is the purpose for which the DSAs should be fit? Who decides? How are they used? At the end of Sherilyn's talk, she mentioned different ways of looking at DSAs, so as an early warning tool, as a better guide for fiscal policy formulation, for example, and broader domestic economic policy formulation, and as well as for lending by the multilateral institutions. Well, those are all different, right? You might get very different DSAs depending on which of these you use. On the other hand, there may well be, a Venn diagram where there's a sweet spot for all of them. And then I do also want to go back and highlight something very important that Matthew raised when he talked about the demands of world citizens. And, Tuvalu and Chad do not have the same voice and vote in the boards of these institutions and in matters of debt sustainability as some other countries. So if in fact this is about addressing recommendations in a practical fashion to institutions that already have something called debt sustainability analysis, be it for low-income countries or middle-income countries or any income countries, well, those institutions also have voting rules. They also have rules about, making sure that when they lend, they're repaid. So is it really a place where you could have an impartial debt sustainability analysis, right? The whole mandate is not to be impartial, at least arguably so. But again, perhaps what we're looking for is the
overlap space, right, where all these different purposes coincide, where different uses can be made of this methodology and of the results that it produces, and where all these different stakeholders coming from different places can have a voice, right? And then I'm still struggling with, and I think this is critical in Mahmoud's presentation, which is, if not debt, then what? Or rather, beyond debt, then what, right? Domestic resource mobilization, different forms of external resource mobilization, all of these have to come into play, and isn't something called debt sustainability analysis a thin framework for as complex and rich of a task? So those are just some reactions to what I think has been a very rich set of presentations. I think we should try to get questions from the audience and then go in, maybe in reverse order, actually. Thank you.
Good afternoon, and thank you very much for the presentations. I'm Dan Black from the Ministry of Finance in Jamaica. Happy to be here. So I have two questions, one for Ms. Hurley and the other for Mr. Mahmoud. The first question, really, debt transparency. Ms. Hurley, you mentioned making the DSA more accessible to non-specialists, and you mentioned about even in local language, if I heard correctly. But I wanted to know what other methods you suggest because from where I sit, we do a DSA, we publish it on the website, and we are of the view that only specialists really use it, you know? So, I mean, how do we make it simpler? I'm really grappling with that thought as to making it simpler and what would be the impact on, and for example, cost of financing when we do that. So I would love to hear your thoughts on that. For Mr. Mahmoud, if I may, you mentioned, and there has been talk about local currency financing and really issuing local currency globally and getting, international investors into the local markets. The analysts certainly are looking at a stronger US dollar. What are your views in terms of the impact of a stronger US dollar, if there is one, and if the US dollar becomes stronger, impact on local currency financing for sovereigns who are moving in that direction? Thank you very much.
Thank you. Why don't we collect two more questions and then go around the room? 1, 2.
Yep. Thank you so much for your presentations, for your insights. My name's Christina Lascaridis. So I'm just going to get back to a few of the points that I heard to sort of stimulate debate a little bit further. So I'm going to start by one of the last things that Anna Gelpen mentioned about whether this is a slightly thin framework to deal with this very complex situation. And I say that because despite the improvements in the DSA methodology, which is mandated through the frequent reviews, there is a way to see this as a sort of development of bells and whistles, drawing to people's attention some of the ways that you can easily improve the framework, the baseline realism tools, bringing in market signals, some new plugins. But I do feel this is an opportunity for looking at slightly more fundamental questions about how the framework operates and what's sort of driving it. So the role for the institutions themselves, the fact that they actually provide operational significance. The outcome has operational significance for the institutions, especially in the LIC DSA framework, but also the role in times of debt distress. So in that context, I just want to, because it was mentioned a few times, the positive role of multipliers. How can we include in the framework what positive impact spending on SDGs would have for these growth projections, okay? There's all this concern about over-optimism in the growth projections. There's a question about what is the underlying conception of the economy in the DSA. We're talking about extending projections based on a very simple process without an underlying clear conception of the economy. And this came across so potently, maybe people recall, in the multipliers debate during the Eurozone crisis. Okay, the mea culpa, Blanchard and Lee result of the fact that they had underestimated the negative multipliers. If you consolidate, what's going to be the impact on GDP? That's why you had this forever chasing of your tail, right, of GDP falling faster and the famous graphs of the IMF reviews and assumptions going down, down, down. So what's driving that kind of figure? The fact that there's no clear conception of what drives the economy. That's why it's so hard to integrate spending on SDGs having positive outcomes of growth. And interactions, if you have a recession, is it going to affect the other variables, the interest rates, exchange rates? These things are simplified in the DSA, and I think actually looking at the kind of model that's driving the assumptions, which is the main thing that drives things, needs to come to our attention. I also want to harness the point and amplify the point about stakeholder engagement and the role of, like, do citizens agree with the results? And that's a really big ask. If you just even ask, do creditors all agree with the results of the DSA? And again, you have many instances in crises. Again, the sort of precarious balance in the Troika was an example of the European Commission disagreeing with the IMF on the results, and it was being fought over the technical time horizon. So one more point, very quickly. The degree to which the DSA result is shaped by how much money is on the table, which is the financing and debt question. What hope, and this is a question to the panel, given that the financing on the table might determine the DSA result, what hope is there for reform to make this tool more of a debtor's tool as well as a creditor's tool? And that's an open question for you. Thank you again so much for your...
Thank you. And last question, and then we'll go around the panel. Thank you.
Moderator. My name is Ibrahim Al-Badawi. I'm from the Economic Research Forum for the Middle East and North Africa. I would like to stress the importance of the SDG-based budgeting, because I think it's not only the budget itself, but also the process that leads into the budget could actually serve a very important purpose in terms of self-reliance and ownership. And as Dr. Mahmoud suggested, I think it would be important to link SDG-based budgeting directly or very prominently, actually, with the DSA and the entire analysis of resolving debt and debt sustainability. Thank you.
Thank you so much. So let's mix it up a little bit. Let's start with Gail, then Mahmoud, and then Matthew, because Sherilyn is not available. Thank you.
Thank you, Anna, and thank you all for the rich contributions. I realize time's short, so I'll perhaps mostly focus on Ms. Black's question. So thank you for that. I mean, I think it comes back to this question of what purpose is the DSA for, and who is it for? And I think we do see very clearly that the audience mostly for DSAs is lenders currently. And some other research that Matthew and I have been involved in over the last year for the International Budget Partnership, looking at debt accountability to national stakeholders. And we've seen very clearly that it's only when there's a crisis that national parliaments, citizens, associations, media, other stakeholders engage in debt issues. There's not sufficient engagement on an ongoing basis. Maybe Jamaica recently is an exception to that. Jamaica's been on a remarkable debt reduction journey over the last decade. And it has involved engagement with citizens, with the private sector, with other stakeholders on an ongoing basis to involve them more fully in that journey. And I think it's about how we can make some of the very rich information that is in DSAs more interesting and accessible to national stakeholders in times of non-crisis, right? We don't just want them to engage when a crisis hits. So, of course, there's the languages issue, but some of the recommendations I make in the larger paper, it's about bringing some of the key assumptions right up top. So it's about, well, what is the quality of the data that we're working with, and having a traffic light system? We need to know that. Let's bring that up to the top. What are the assumptions on the growth rates? What are the assumptions on the borrowing rates? And what is the mix of debt? And bringing all that right up to the top so that time-busy people and people that don't necessarily understand fan charts and all of the rest of it can actually engage in more meaningfully. And the language issue is really important. So many of them are available in English only. It's a massive problem. So I think these are some of there should be quick fixes, right? These are not difficult things. Thanks.
Thank you, Gail. Then Mahmoud and then Matthew. Yes, we have 3 minutes and some seconds. Mahmoud? With Matthew, and then if Mahmoud would like to chime in, he can do that.
Okay, 3 very quick things. One is to say that I think we need to look at the different uses of DSAs and say whether they've worked or not. Clearly, they've failed as an early warning system. Why do I say that? Because essentially, it was only earlier this year that we all went, there's this silent debt crisis, there's a debt service crisis. And the reason for that was that in the way that DSAs are interpreted, the whole issue of liquidity of debt service burdens, including domestic debt, is very underplayed. And I think that's one of the most important reforms going through. Needs to be a much stronger coming out of that in the analyses and in their presentation to boards. Secondly, I think we really need to highlight, and particularly what Christina was saying in relation to this, the conflict between what is currently going on in countries, which is a very large short-term fiscal consolidation with very potential negative multipliers. So if you look across Africa, it looks like we're going to be trying to find budget savings of 4% of GDP over the next 5 years, which is the complete opposite of expanding for the SDGs. And then finally, just to end on a positive note, because I think lots of people were asking questions about, is this really doable? Do we really know how to do this? Look, we did it before the DSF existed. We worked with 30 countries, all of HIPICS, to actually work out how to do this more ambitious scaling up type DSA. And we did it in Bolivia, we did it in Rwanda, we did it in Tanzania, where you actually say, here are the multipliers, you can put them through a very simple economic model, you can even do linear projections of them, and then you can use it as a tool to go to donors and not just accept the amount of money that's on the table currently, but ask them for more, and ask your citizens for more in terms of paying taxes in return for services. And then you can actually scale up. So I think that's where we have to shift our mindset and actually have a positive attitude to getting this done. We want to do that over the next couple of years with FES and other partners.
Thank you so very much.
Can you still hear me?
Yes, let's do this. Yes. Please, Mahmoud.
Yeah, right, in 30 seconds. The first point, fit for purpose or not, depends really on how you define the purpose. If you are revising them based on 2017, and you check the response to the review of the debt sustainability analysis for low-income countries, I hope that you'll not be surprised to see the outcome that they are fit for purpose by detecting the kind of alarms with a minimal kind of false alarm. So this is basically how they are being judged. Are they fit for purpose for the current world with multiple crises post-2017? That's why they are revised. The second point on local currency issuance, yes, they are very much important, especially for borrowing for projects that will not proceed any kind of or result in any kind of receivables in foreign currency. But again, there is a great deal of risks involved in that as well, including the inflation risks, and there could be more flexibility than the kind of elements related to the external debt. And the very final point, the SDG-based budgeting, yes, there is a system in place. Vitor Gaspar, the head of the Fiscal Affairs Department of the IMF, did a good job back in 2017, 2018, but it's not really about lack of an approach, but basically about countries to use this approach and apply it going forward. Over to you.
Thank you so very much, and thank you again to our hosts and to all the participants for this rich discussion. It's, yet again, only the beginning. Lots of work to be done. Thank you.
Thank you very much. The next session is going to start at 1 p.m.